Check. All right. All right, y'all. So, welcome to the 2026 or Retrading Group Mentorship. This is the first live stream. Just testing things out. My computer's a little bit slow, but we're gonna power right through it, right? Okay. So, where are we right now? So, what we're looking at right now is the chart for the monthly chart for micro gold coin or MGC one. See on the top left, that's the symbol. So what we're doing today is that we're going to do a market projection into the next week, into the next month, where we think the next monthly candle, next weekly candle, next daily candle is going to form, what range it'll explore. And what we'll do is we'll make a estimation of where we want to see the market to go or where we think the market is going to go on those charts, right? So we always do top-down analysis. We start at the monthly, go down to the weekly, daily, and then we go all the way down to our entry time frame, which for us and the way that we trade is the 5 minute and the 15 minute. Okay, so here we are looking at the monthly chart. What we have right here is the creation of a large range using, if you look at the bottom, the March monthly candle here. You see? So we want to see the market explore. At some point, it will explore either the low or the high of this March candle. This March candle is maybe on record the largest price change in gold's history. So we want to see it explore either the buy side liquidity here or the sell side liquidity. So that's the long-term target um, or the long-term monthly range extremes that we want to see price explore. Okay. So looking at the last month, which was April, the completion of the April candle, because it just turned May, the April candle just closed. This means that we created a um, monthly range, right? So we have the uh, range for March here, then we have the range for April here, and now we're in May, so we want to see in May how do we trade at the extremes of the April monthly candle, i.e., the high of April or the low of April, okay? So now let's go down to the weekly, okay? All right, wait, first before we do that, I can just label like straight up. Just label like what we got here. So we got the April high, So it's the 04 2026 high. And then we have our, just gonna clone this, our 04 2026 low right here, just about. I'll adjust it. Uh, Please excuse the going a little slow. Um, I'm gonna need a new computer. Soon I'll be able to get that. Okay. So, like I said, like with that monthly range, we're just labeling here we have the monthly high, the last monthly high, the previous month high, previous month low, and then what I also have labeled here is the um, lower wick of the March range. The reason why I have this labeled with the Fibonacci tool here is to grade the quarterly levels of that monthly range. The reason why is because we can treat wicks as gaps that we can label, but also the reason why we have it labeled here is because we could possibly use these quarterly areas as places of support or resistance where we can see whether or not we get a pattern on our entry time frame. So whether the 5 minute or 15 minute, we can view whether or not we get an entry pattern at any of these wick grades here. So those are the things that we have labeled for our monthly. Okay, so that provides us guidance. Um, so now let's take a look at this. So we're gonna get rid of that, and we're gonna turn this into. All right, so that's both the April 2026 low and the previous week's low. Okay, so we have that labeled there. And then we have that weekly high that we have labeled, but we're also going to label it the 04 2026 high. Okay. Okay. Just to clean things up first and foremost. So, looking at this after coming from the monthly time frame, I'm automatically I automatically want to go back up to the monthly time frame because what I see here is that this April candle, so the monthly range for April, was so small compared to the last monthly range. And what we know about the way the market moves is that it goes from consolidation to expansion and then back to the consolidation to expansion. And what we have here is an expansion candle in March, a consolidation candle in April. And so now for the next couple of months, probably into the next quarter, so I want to say, what is that? That'll be July, August, will be the beginning of quarter three. I want to see by quarter three whether or not we are going to get another expansion or if we're going to trade within the larger monthly range that was established by March. Okay. So I'm just viewing it, right? I'm just marking, hey, this is consolidation in April. We don't know if we're going to get consolidation or expansion in May, but what we want to check for is how we react at these range extremes, so the April low, April high, and whether or not that will take us to our March high or our March low. Okay, so that's why that's important because we see how we have a range established here, and we want to see it break out of that range to see if we get a consolidation. We want to cast a consolidation move. I'm of the opinion, long term, longer range, that we are going to continue going high. We've been doing nothing but going high, or going higher and higher, and because of our geopolitical situation, um, as well as the debasement of the dollar, I don't see gold going super low. I see gold continuing to melt up. Um, cool. All right. So no distractions. Even though it's so fun texting. Um, okay, cool. So what we're gonna do now, after checking out that monthly range, right? We want to see what happens at the extremes of April. That's what we have established here. What we're gonna do now, first we're gonna make sure we can make this visible, the weekly. Cool, cool. So looking at this weekly, right? This is our previous week's candle, right? It's Saturday, as you can see. So the candle or the next weekly candle doesn't open until tomorrow. I'm in CST, so it'll open tomorrow at 5 p.m. for me, but it's usually 6 p.m. EST is when it opens. All right, so if we look at this previous week's candle, right? We broke out of this. Hold on, hold on. We don't need too much of that information back there. We broke out of this range that was established on April 13th, right? And the reason why this is a range is because the very next candle after it, it didn't trade to that candle's high or that candle's low. It stayed within the previous range for April 13th. So we're talking about this candle here. April 20th stayed within the range of April 13th. What we got was an expansion out of this consolidation that happened here, on April 27th. And out of that expansion, we got a reach all the way down almost into the 330 new week opening gap, right? But we didn't quite get all the way there. And instead, what we did is we got back above the low of this range here, this range low here. All right. So we're just purely just looking at what happened. Because we got all the way down here, all right, this previous week, and we traded all the way back. I want to say that's above 50% of the entire range of that previous candle, of this candle here. So let me use the Fibonacci tool just to grade price. So we almost got above 50% of the range. But the fact that we came all the way down here and then we almost traded above 50% of that range tells me that there is either some more consolidation to happen or there is a significant enough buying pressure up here, right? Now, I don't really like that it didn't get all the way down here to the new week opening gap, and then traded up. And I don't really like that it didn't close above the 50% mark of it, right? And I'm saying I don't really like it because I'm of the longer term vision that I want to see price continue to go up. So because my bias is up, and I see that we didn't get all the way down here, and we did get above the low of this weekly range, but we didn't get above the 50% range for that candle itself, tells me that we could see an exploration of price going lower into the next week. Despite me being on the longer term vision that I want to see it go higher, we could see on a weekly basis that it goes a little bit lower. Okay, so what we're gonna write here as a label, because again, we haven't gone over it completely, but all we're doing is labeling highs, lows, gaps, new week opening gaps, um, and then grading using our Fibonacci tool. So after grading that, what we see is we're going to write down exactly the analysis that we found. Price, um, previous weekly candle expanded past April 13th weekly range. Mhm. Range did not use major PDRA to trade back above the 0413 low and closed to close back above the 0413 low and close below um, the 50% of current weekly range. This is likely to still be consolidation. I want to see how, I want to see if we get a trade to the March 30th new week opening gap or to the previous week high. Okay, so right here, just by me looking at the monthly, right, and then grading and labeling the new week opening gaps, highs and lows, and then going down to the weekly, and then seeing how prices moved, whether it moves to expansion or consolidation, that's how I'm able to establish a weekly bias. So right now, because I recognize that, look, it's likely to still consolidate. The reason why is because we took the sell side liquidity here, right? We took that sell side liquidity, started to run down even further, made it all the way down to the monthly wick grade of 75%, almost made it all the way down to the new week opening gap, but did not. And the fact that we see that we did not get all the way down here leads me to believe that there's still some sell side liquidity here, i.e., people that are still willing to do a sell stop because they think it'll go down, but instead, the way the market works, these large institutions want to take that liquidity and take all the trades that think it's going to go down and then reverse it. So we're trading reversals here. That's kind of how I like to do it. Unless I get a really obvious like internal range liquidity like change in the range. But for right now, I want to see how it trades at the extremes here, right? And it's really prime in my opinion, that it would get back down here because there is no sell side liquidity traded here, i.e., like there is no black candle that goes through this area that we have, the gap here, and we have a low already established here. So I wouldn't be surprised if it goes down and takes the external range liquidity and takes the internal range liquidity before we start to go back up. Okay. That being said, we want to see if we get one of our patterns here, i.e. the inversion fair value gap, as well as a change of structure in this area. So it's likely that we'll continue to consolidate, in my opinion, looking at this, but um, I want to see us get down here, basically. I'll prefer for it to go down here. So I'm neutral to bearish going into the next week, just looking at this market, because I want to see it come back down. All right. We could be wrong, we could be completely wrong. And I mean, in that case anyway, I don't even want to trade going up unless I were to see like we get to the previous week high and then we get one of our fair value gaps of some sort in the previous week high area. But I'm of the opinion I want to see it come back down here to be more efficient, and then from there trade up. So let's be careful going into this week because it is the first week of May. April was pretty difficult to trade. There were barely any trade in the last week. And we have Kevin Warsh that will be becoming the Fed chair on May 15th. And there, because of that, there may be some adjustment to monetary policy as a result of the Fed's powers shifting. All right. Let me do this real quick. Keep this in the back. All right, cool. So we have our bias established and the projection into next week already established, right? Now, remember I said I want to see maybe it seems that there may be some sort of liquidity here. Obviously there is external range liquidity here at the low and internal range liquidity here at the March new week opening gap, the March 30th new week opening gap. I just want to go down to my entry time frame, or actually I'll go down to the daily first to see what I see there. Okay. I labeled the daily SIBI here. You can label any like sell side imbalance, buy side inequality, buy sell side imbalance, buy side um, inefficiency. But I'm labeling this one specifically because it overlapped that previous week low, and it overlapped the April 13th weekly low. So because it overlapped both of those lows, I think it's high probability for us to see a move coming out of this daily SIBI or this another example of internal range liquidity. So let me see. I labeled the previous day low here, also labeled the previous day high. It's possible that we could get some sort of like movement there, but what I'm looking at is, all right, we're focusing on this low here. All right, we have that low. Let's see. Is there any example of more liquidity? All right, so we have an example of priming here. Priming is when we have a low to the left and a higher low to the right of that previous low, right? That's sell side priming, i.e., the market doesn't like how smooth that is. Graphically, I'm talking about, right? Because it gets more complicated when we think about value. But graphically, when we're looking at this, like here's another example of that previous day low on the 4 hour, we have more priming here. So it's likely that it may want to take this out, especially at an external range liquidity area like this daily low. All right. Now let me see I'm just going to go down to entry time frame. Is there a deeper example of priming at the indicated low that we have here? So not necessarily here, but for the previous day low, there's definitely some priming there. So, like I said, I'm more interested in seeing price come down here, at least to the low here, and more likely I want to see it go into this new week opening gap before we go all the way back up. But like I said, I don't have to be right. And the reason I'll know if I'm wrong is if, let's say, we get up to the previous day high here, and we get up to the daily SIBI here, and then we get a 15-minute fair value gap um, that it respects. And if it respects it, then I'll probably expect it to go up. And if it doesn't respect it and we get an inversion fair value gap here, I'll probably take the trade down all the way down to the previous day low and then all the way down to the new week opening gap. That's honestly the one trade that I want to see this week. That's what I want to see. Um, yeah, that being said, if we get like choppy consolidation type market like this, this previous week, I'll probably not trade like I did this past week. But yeah, that's what I that's what I see. All right. All right. Cool. All right. So that concludes the first part of this stream, which is literally us just making a weekly projection where we think the market is going to go. I always do that on a weekly. Um, that gives me a better idea of what I want to see. Um, I'll say it again. I wouldn't be surprised if we continue to consolidate. However, because we have this liquidity area here, this liquidity complex here, the external range liquidity above the internal range liquidity, I I really want to see it come down here. So I'm more bearish than bullish, but because of the way this last candle moved, i.e., we explored the sell side liquidity of the established weekly range, and then we closed above the low of that range, but we closed below the 50% area of the current weekly candles range. That's too much reasoning for it to go up or down. So it's equal reasoning for it to go up or down. So there isn't too strong of a bias. However, I would like for it to come down here. Okay, cool. So that's literally what I'm trading going into the week. I'm not touching oil. I'm not even touching um index futures. I haven't really been liking the way it's been moving. Let's put it at that. Let's make that really simple. All right. So now we're just gonna do replay for the previous week. So what I like to do every Saturday, besides looking over the trades that I took over the previous week, I'll go through every single day and basically establish a bias where I think it's gonna go from that bias, and then play out on my entry time frame to see where whether or not there was a trade or if how I would think about the market live, right? So we're gonna go to replay mode. We're gonna get rid of this week. All right. Um, Yeah, for the sake of replay, listen, I'm not gonna pay attention to the established previous week high, previous week low, or even pay attention to this little thing that I wrote. I just want to let's put our brains back into the perspective of, all right, this is the candle, this is the current week. Let's imagine it's Saturday, of last week, and this is what I see. All right. So obviously we have previous week high there, previous week low there. We're gonna label it. Um, we're just gonna label that with green, and then we're gonna label that the low with red. Yeah, we're gonna label it with red. Only reason I'm doing this is just so that I remember what is the previous week's low and high, compared to what we have labeled for the current week, right? All right. So now let's go to that daily, right? So this is how I'd be looking at it. Please ignore all of the things, like ignore that, ignore that, ignore this previous day low, ignore that low, ignore this new week opening gap. All we're looking at is boom, this high, this low. We have this previous day low and this previous day high, and then that previous day low there. So when the market opens, that next, like at 6 p.m. on Saturday, 6 p.m. EST on that Saturday, right? Just pressing the forward button down there. We see we got the new week opening gap that forms here. Really small one. Really small one. Um, well, it doesn't really show it the way that I want to. That's fine. Okay, so obviously we have that previous day low, previous week low there. When I'm looking at the market 6 p.m. or that night on Sunday, last Sunday, I can tell you directly I was literally just waiting to see if we get some sort of fair value gap at this area, which was that previous week low at that point. And if you see on the entry time frame on the 15 minute, we have some priming here. And remember what priming was? We have a lower low on the left and then a higher low on the right at an extreme, or at like a visual low on the higher time frame. So that tells me, all right, it's likely that price can get down here just to make that jagged. All right. And I only pay attention to priming, by the way, at higher time frame PD arrays or higher time frame areas like this external range liquidity area or the sell side liquidity. All right. So literally, I don't even, I don't care about that. Cool. We go up. I'll go up a little bit. Just keep this in the middle. So I would have been looking at it like this because it just as likely could go up as it could come down. So I'm looking at it, watching it, or not really watching it. Just I set my alarm at this low, and then I set my alarm, I believe, at the high of this new week opening gap for that orange area. I always label my new week opening gaps with orange, by the way. Um, yeah, so I would have literally I would not have. This is Monday, you see, obviously Monday 10, 11. I would have woke up the next Monday, looked at the market, yawned, and left it alone because it didn't get to any of the areas that I wanted to trade at yet. Only areas that I'm looking at is up here or down here. Cool, so it's not doing anything. all of Monday, didn't take a trade, didn't even really look at it. All right. So now we have the Monday low there and the Monday high there. So I want to see how it trades at the Monday low, Monday high. As we can see, automatically we got a complex where we got a 15-minute, we got a 15-minute SIBI that overlapped the low, the previous week low that we have labeled in red here, this red line, and overlapped the previous day's low, Monday. So automatically in my brain, not even just in my brain, I believe I even put this in our group chat. I labeled this here. Boom. We got a 15-minute SIBI right there. Um, I label all my SIBIs in red and I label my BISIs in green. Cool. So what we saw there is, look, we got the 15-minute SIBI here, but we did not get an entry, right? So back up actually. I would have seen it get down here and then we got the SIBI, which would have told me, all right, we are going to continue to go down, right? Where do I want to see it continue to go down to? More than likely at the April 13th low, right? So I would have wanted to take the trade. This would have been my exit point here at that April 13th low. I would have had it labeled because it was the weekly range that we showed all the way on the weekly time frame before. But I would have had that labeled. Boom. I want to see us get down to here. That's what I would have seen or what I would have said had I seen this 15-minute SIBI. All right. Now, because we are in such a consolidation market, obviously you would have seen like you can go to the next candle, go to the next candle. All right, you see, it would have gotten here, right? And if we actually got our entry on our time frame, i.e., I would have taken the trade here, so the SIBI doesn't form until we get the end of the 1:15 a.m. EST candle. So I would have drawn the 15-minute SIBI at 1:30 when that candle closed. And then after 1:30, I want to see it come back up here. We didn't get the entry. Usually I like to do 20 point, I do a 20-point stop, and then I go all the way to my target. We would have been shooting for a 2.4 to 1 trade. We didn't end up getting it. Now, the trick about trading is a lot of people, and the way that we've been conditioned is that we work hard in order to get what we need, right? We push harder to get more of what we want, right? But that's not the way the market works, and that's the really important psychological like shift and change about trading is that you don't have to work harder. You like quite literally in this cliche, but you have to work smarter. You have to know when to do it or how to do it, right? So this goes back to us looking at the structure of the market, right? And looking at these 15-minute candles. When we open up and we create this new week opening gap, the current week, new week opening gap for, what was it, April 27th, we can see the way these candles are forming, a lot of the successive candles are covering up to 70% of the previous candle's range. And what do we know about that? Whenever the successive candles cover 70% of the previous candle's range, we are in a choppy market or consolidation market. So, seeing that on the 15 minute, all right, I remember because I actually did do this. I went down to a smaller time frame, the 5 minute, which is another one of our entry time frames. right? So personally for me, and I'll just like be straight up about this, I did actually take this trade where instead of the 15-minute SIBI we were paying attention to, I paid attention to the 5-minute SIBI that was here, that was formed here. Paying attention to that 5-minute SIBI, the reason why I didn't actually end up like getting this trade fully or winning the trade is because I knew we were in a consolidation market, and then I saw very precisely. Let me select the bar. So we formed this 5-minute SIBI here at the previous week's low there, labeled in that by the red line. As soon as we did that, we got that SIBI. Now automatically I set the trade to be here, and my target was that weekly range consolidation range low, or the 413 low, weekly low. Boom, got into the trade. Boom. Very next candle, we closed above the consequent encroachment or 50% mark of the SIBI. Us being in the consolidation market, I was like, I don't really like that. And I didn't even wait for it to become an inversion fair value gap. If it would have become an inversion fair value gap, I could have used that as a reason for it to go up. But me being quick and automatically not liking it because of the consolidation, I just got out really quickly. Only took a, what was that? A 4-point loss. Now, in that case right there, that's how I knew this market was going to be difficult to trade. Why? Because it's not automatically using that. It closed above the 50%. I don't want to see it close above there. I just want to see it wick it and then automatically drop out of it. It closed above it, I got out. But it being a consolidation market, it closed above it, pointing towards maybe possibly it wants to create an inversion fair value gap. And then it said no. And it started to actually fall down. So what lesson did this teach me? Honestly, be willing to take the full loss only after, only if your trade is invalidated. My trade was not invalidated by it closing above the 50%. My trade would have only been invalidated if it closed above the SIBI entirely and then created an inversion fair value gap as a result of it closing above there on the 5-minute. It didn't. I ended up taking a 4-point loss, which was literally nothing. But as a result of that, I left money on the table and I missed out on a 2-to-1 trade, which is fine. But this just shows you how like precise this gets, you know? So let's just see how long it took. We would have gotten that trade. But you see how, oh man, you see how slow that took so long for it to just happen. Uh, let me let me show you with this tool how long it would have taken you to get to take this trade. It would have, just to get a 2-to-1, it would have taken you 4 hours and 15 minutes to get that 2-to-1 trade. That alone tells me we are in a consolidation choppy market. A couple weeks ago, it would have taken 5 minutes to get that 2-to-1 trade, had it been like directly like um using the PD arrays properly. But whenever we see it like take a long time using PD arrays, or we see it like use the PD array and not fully go to an opposite price delivery array or to like a target that you have there, that's how you know you are in a consolidation market, and it's probably best for you to keep your risk low, and then like for the sake of your mental capital, not even really engage as much in it. Which is why, like you see in our group chat, I didn't really text at all. Especially after we got to here, right? So we got to here, which was again the remember we had the range established by the 413 weekly. candle. So we got here, go down to the 15-minute or entry time frame where we're watching the market. So obviously 216, uh, that would have been a trade that worked. The one trade that did work off of the 5-minute SIBI. Um, cool. So now we're back on 15-minute watching the market, and now we're here. So from here, I want to see, okay, are we going to get a range expansion? Remember, because before, look, we were in a weekly, we got obvious consolidation. How do we know it's consolidation? We have a weekly candle, then the very successive candle is within that previous weekly candle's range. It didn't get to that high or low, so now we have a range or a consolidation range. And now I want to see, do we get an expansion? And which direction? How do we get the expansion, or do we continue to consolidate, right? So from here, the idea was we could honestly get to that low and then get a reversal signal to go all the way back up. Or we could get to this low and just continue down until we get to the next PD array, possible PD array that we could use. So when we get to that 15-minute area there, I want to see automatically, I want to see, do we get a SIBI? Do we get a SIBI that forms there? Do we get something that tells us, all right, we want to continue going back down? That SIBI tells me in this direct area, so this external range liquidity area, this red line, which we can just label like real quick for the sake of the video, the 0413 low. Do we get the SIBI there? That's like, I had my alert, I had my alert here. Let's just say I didn't take the trade. All right, cool. I got my alert here. Now I definitely want to see if we get a trade there, or if we get a entry pattern there rather. So that 15-minute candle forms. So then automatically, not only we don't get a FIBI, what we get is a balanced price range. Now, I included in our text um, a really helpful graphic from a creator on X that lays out all of the PD arrays that ICT or Inner Circle Trader puts in his mentorship on YouTube. Really useful, really helpful. You should look it up. But basically, we get a balanced price range here. A balanced price range is dignified by there being a directional candle in one area, and then the very next directional candle utilizes the entirety of the next of that range. And we pay attention to balanced price ranges where specifically at our external range liquidity areas, internal range liquidity areas, or just major support and resistance areas that we utilize. Highs, lows, new week opening gaps. So we're at this low or this gap, we get a private or balanced price range rather, and we just start consolidating. And then we get that there, and then we get that there. All right, so technically a 15-minute um, BISI, or sorry, SIBI, or sell side imbalance, buy side inefficiency, does form here, and we can label that 15-minute SIBI, but price doesn't go back into it. Just starts to go down. Okay. So at this point, I remember I put a message in the group chat that this does not look like a good week for it to be trading because a balanced price range is consolidation. You can utilize it as a trade if you wanted to, i.e., you see this candle here, the 7 a.m. candle, that 15-minute candle, the way it drops down out of it. You could utilize this area, or I'll label it as a balanced price range. The thing with ICT is like you can you can become a master of all of it, but you don't need to do all of that. Sometimes you can confuse yourself with all of the different um, ways of explaining or PD arrays that he utilizes. He even says in his live streams and in his videos, you don't need to use all of it, that you can confuse yourself because he's coming from 30 years of doing this. Um, and we're not. We're trying to figure this out for ourselves. And personally, for me, I don't really benefit from utilizing balanced price ranges as much as I utilize inversion fair value gaps or just fair value gaps at these external range liquidity or internal range liquidity areas. So we have a 15-minute balanced price range to describe it. We have that forms. So you could technically, if you were if you traded balanced price ranges, excuse me, if you look at the bottom, that 7 a.m. 15-minute candle would have been your entry. How would you have known that this is a balanced price range? Obviously, you see the candle 545 goes all the way down. It goes down below the April 13th low, and then the 6 a.m. candle immediately goes up and trades into the entirety of that previous candle's body range. So that's how you know that's a balanced price range. That's why we have it labeled as the 545's candles open. Sorry, open up here, and then the candles close, or just the body of it. We have that labeled there. You would have been able to take the trade here from at 7 a.m. Now, where would you have been targeting? Has you seen this and was like, ooh, this is a, sorry, excuse me, this is a 15-minute bearish balanced price range. Personally, if you're asking me, I'm like, ooh, we got to the 413 low, and then we got a balanced price range that formed there. Okay, that's a PD array that I can use. I want to see price go all the way down to our next area, which for me would have been the 330 or the March 30th new week opening gap. So I would have labeled that there, and boom, I would have been expecting a 5-to-1 trade. But again, we are in a consolidation market. So yeah, you would have been able to get some good. I see, I almost spoke too soon. Do you see how so you got in because of the balanced price range, and then you maybe got to what, half of the expected? So you see, for me, because we were in this consolidation market on the 15 minute, you can obviously see we're taking up successive candles at least 70% of the previous range for every successive candle. I would not have taken this trade, and I didn't take this trade. Why? Because for me, when I'm looking at the market and I'm using ICT trading or smart money concepts as they've labeled it and marketed it, at these external range liquidity areas or internal range liquidity areas or the extremes of external or internal range liquidity areas, I want to see fair value gaps. Fair value gaps for me points me in the direction of where I think the market is pointing to, or where it's showing it wants to go to. That balanced price range, while it is some people's PD array that they use, it's not mine. So we got there. We wouldn't have gotten all the way down to the market just yet, because I remember eventually we do get down and we establish that low here, which would have been a whole nother next day. So you would have needed to be, in order to get all the way down close to the 330 or your target down here, you would have needed to wait almost a whole nother 24 hours. And for me, that's not that's not that's not what we're here to do when we're day trading in this specific way and this mentorship and the Ori trading group mentorship. We want to hit the market where it's going to be fast. That being said, right, we had that balanced price range that we labeled, but ooh, we forgot about this 15-minute SIBI that we labeled here after it formed the balanced price range. So it got all the way up here at that 15-minute SIBI at the low or the 413 low, and it created a valid SIBI after creating a balanced price range. Now, if you were a super advanced student, you could have taken that trade. If you're shit, if you're ICT himself, he probably would have seen that and taken this trade, and been able to see, ooh, yeah, we're in, and taking that trade all the way from there. And again, because that 15-minute SIBI is formed here, I wouldn't expect anyone to like have the target anywhere else other than down here at the 330 new week opening gap. But you see, it didn't even get down here. And the time that it took for it to just get to that low, which isn't even actually the target that we have here, the intuitive target, or not the intuitive, that is the target that you would have shot in for. Um, what's that? Would have taken 13 hours to get, I mean, 13 hours for a 5 to 1. It's just like, it's just not, it's running efficiently. It's not running um, inefficiently. And we want to be in trades that are running inefficiently towards the targets that we have. 13 hours for that trade, kind of a lot, especially given where we are, right? So we had that low, Tuesday low. We probably would have been able to label that. We didn't get a, we didn't get any um, fair value gap past that. So again, like there was technically a trade there, but for our system, that's not a trade. That's not something that we want to take. All right. So and then just to save you some time, like we would have again no trade on Wednesday, and then we have the low here. We have the low that we would have been looking at, and then we also have the high. This is Wednesday's high technically. We didn't get to the low or the high. Oh, okay, we got to that high. All right, cool. So we got to, what is that? Wednesday's high. So that would have been for Thursday. We got to Wednesday's high and then we formed a 15-minute fair value gap there. 15-minute BISI. Cool. We got that. Because we got it, I want to see, okay, boom. Where would we go from here, right? So, wait, let me back up just so I can simulate what I would be thinking at that time. So, Wednesday's candle closed. We look at the daily. At the end of every day, at 5 p.m. EST every day, we're going to look at that daily and see where we are in regards to our weekly target. The weekly target for me was, ooh, I want to see if we get a reversal at the previous weekly low, or if we expand past the previous weekly low. We ended up expanding past it. So I'm like, all right, we expanded past it. Now I want to see, do we want to go back up into this SIBI that was formed here, or do we want to go back down, and create a new low for the week, right? So that's what I would have been thinking for going into Thursday. Do we take the high? Do we take that low? If we take the high, it would be ideal because then we could take a larger trade from the daily SIBI to go back down to the new week opening gap and create a new low. But we're at Wednesday, right? Or sorry, we're at Thursday now. So there's only 2 more days in the market. That doesn't usually mean something, but in a consolidating market, where at the end of the week, I don't really know if I should really expect there to be a new high or a new low created unless we just get the correct PD array matrix created in the daily SIBI there, right? So, um, cool. So, all right, market opens Thursday. The only thing I would have done is set an alarm at the previous day high, which I always do, and the previous day low. Would have just set the alarm there, especially because we have the SIBI that is there. So I want to see, all right, cool. If we're gonna go down, we're gonna go into the SIBI and from there give us the right market structure for us to point downward towards the new week opening gap. We we formed that busy there. So I'm like, ooh, okay. But remember, I'm looking to see, okay, are we gonna get sales out of here? Okay, we formed another uh 15 minute we formed a another 15-minute busy there. So I'm gonna label that. All right. The reason why I labeled that is because we got the 0% area of the SIBI, then we got to the 50% area of the SIBI. So this is a major external like area. So that's a major area where we want to see if any fair value gaps form, as well as the consequent encroachment is another area we want to see if any fair value gaps form. And then the 100% area is another area where we want to see if fair value gaps are forming there. Fair value gap formed there, all these areas. Okay. Mind you, okay, if this is a reason for the market to be pointing upward, I don't want to see it take this long to come out of this internal range liquidity area or this busy. I want to see it touch it and like no more than 30 minutes go up or no more than two candles formed go up. It's taking a really long time. So it shows me again, this is a consolidation market. So it's just a difficult market to trade in general, which we knew because of how it reacted here at the, I deleted it, but how it reacted here at the 413 weekly range low. And it's taking a long time to just expand away from it, and we created a balanced price range. That balanced price range there at that 413 low would have told us enough for the rest of the week, which is what I put in our group chat. It's not the most ideal week to trade, but that being said, if you are just like a superstar, just like you maybe that you aren't a superstar trader, but you are someone who wants to continue to watch the market, you would have seen that 15-minute BC here now turned into an inversion fair value gap by the 830 candle. How is it turned into an inversion fair value gap? Because instead of it being used as a reason for the market to continue upward, price traded below it, which is an important area. Why? Because this candle is attached to the 50% or the consequent encroachment of the daily SIBI that we have on the higher time frame. So now this becomes a 15-minute bearish inversion fair value gap. Usually the way I do it, the way I label it rather is now I turn it red. I don't usually have borders for my inversion fair value gaps. But yeah, so now that's there. And like I said, oh, I want to use this as a reason. And in a clear-headed market, in a market that isn't consolidating, right? We know that it's consolidating. Why? Because all the successive candles are covering up at least 70% of the previous candle's range, which means we're in a choppy market, which means that it's not the best conditions for us to trade. So let's just say we weren't in those conditions. I would have been able to be like, all right, boom, let's jump into this trade here. 15-minute inversion fair value gap. That's the entry here. Where am I pointing towards in this hypothetical non-consolidating market? Boom. I want to see it take that previous day low ASAP. I want to see it down there. I don't want to see it nowhere else. right? Let's see how that would have worked out. So real quick, we would have gotten into the trade at 8:45 a.m. EST, and then we would have waited the entire rest of the trading day. We wouldn't have made any money from it, or like the trade wouldn't have gone up from it, rather. So now this is just a swing trade that we're waiting on to see if it's going to work, and took a loss. And you would have taken a loss after more than 24 hours in this trade. Now, again, in a non-consolidating market, this would have been the most beautiful trade. We came all the way up into consequent encroachment of that daily SIBI. We took the inversion fair value gap that was formed from that. Um, the candles, they did close a little bit above. They did close a little bit above the consequent encroachment. So that would have like told me, okay, I don't know if this is going to be the best of trades, but we would have taken it anyway because we're in a non-consolidating market, right? Um, excuse me. Um, but yeah, we would have seen that we would have lost the trade. So again, just this is what we do every every single Saturday. This is what I do every Saturday. I'll do the projections for the forward week, and then I'll go back and look at all of the trades, the potential trades for the previous week, right? So there you have it. If you have any questions or concerns, or just in general want to have a conversation about the markets, about getting better at like reading or being an analyst for these markets, and utilizing Inner Circle Traders' smart money concepts and PDRA matrix, please just reach out to me. Leave a comment under this video. Join my mentorship. Just reach out to me. But yeah, I hope y'all have an amazing rest of your week. Again, take your time in trading the gold market. Um, it's something that can be done. It's something that I am learning to do right now. Trying to think any other remarks. Um, yeah, do not touch oil. Oil is a headline-driven market right now. It's not going to make I mean, it does make sense in the PDRA matrix or in the inner circle trader like concepts. Um, but I personally, I don't have deep enough pockets to withstand the extreme ranges that are currently happening in that market. Um, shit, real quick, we can take a look. What's going on over here? Yeah, so I mean, we would do the same exact thing for Nasdaq futures, which is what we're looking at right now. We're at all-time highs, absolute all-time highs. We could continue up. I mean, that the way the market looks right now, we just continue up. I would label the Monday, April 13th weekly candle as a BISI, a weekly BISI. Um, yeah, it overtook the previous all-time high very strongly. So that's a potential area that we could see us like fade back into before push up, or just fade back into before we just continue to drop down even faster. But the way this market looks, it's just pointing upward. So trade with the market. I'm personally not trading this. Um, this weekly range is like absolutely huge. Um, This thing could stay here for weeks. It could go into this weekly BISI for weeks. And I mean, in that case, it's a consolidating market. It's an efficient market. I want to trade in efficiency. But yeah, I mean, if you were looking at Nasdaq futures, I would obviously label previous week low, previous week high. Um, Set your alert for the previous week low. Label the current new week opening gap when the market opens. See how it trades there. I'm just adjusting it. I'm gonna put my alerts just to see. So we might get something here. Yeah, I put my alert at the weekly BISI high. Put my alert previous week low, alert previous week high. Um, for right now, I wouldn't be surprised if it continues going up because it's just pointing upward. But also, I wouldn't be surprised if we start to fade back down into the weekly BISI. And then from here, this is really the area where I would want to take buys. So maybe not exactly at consequent encroachment, but from, I mean, this entire area from 100% of the weekly BISI area to 50%, I'd want to see if we get a 15-minute market structure shift or a 15-minute inversion fair value gap of some sort to start punting upwards again. Um, yeah, so we have gold, we have MNQ. Oh, we can also look at 'cause I know people have had questions about people have had questions about the fuck. So let this load. Okay, real quick. This is oil. Um yeah, I have no interest in this. It's just like the largest consolidation range here. No, I'm not touching that. Um So besides renewable energy futures contracts, which is something, it's a financial product that I've been looking into because I wonder about the utilization of oil as a sustainable energy source going into this next era, Age of Aquarius. Whether or not you believe in that or whatever. Things are changing rapidly. The world is changing rapidly. I'm also looking into, besides renewable energy contracts, which aren't necessarily in CME as of yet. They're in more smaller brokerages. Like there's a couple in Europe. Um, I want to look at. We can look at some grains. So the reason why I'm thinking about grains is because the Strait of Hormuz is just one of it's already by like some sort of international energy council announced that the Strait of Hormuz closing has created the worst energy crisis in the last like decade or so. Uh, Um, so oh, I burned myself. That's what that is. Um, so besides the Strait of Hormuz creating the largest energy crisis in the last century, uh, the other issue with the Strait of Hormuz closing is not only oil, but fertilizers. There's a lot of industrial fertilizers that are utilized from the Strait of Hormuz because it's a byproduct of oil refinement. If those oil refineries are being blown up at any point, not saying that they are, but I mean, Iran has basically threatened that they'll blow shit up if the US tries to invade. And they have already closed and set up a toll for the Strait of Hormuz. Um, yeah, so we're not really getting the right or the same amount of um, industrial fertilizers to produce all the food for the 8 billion people on this earth. And as a result of that, and as a result of like society living the way that we do, and we aren't already creating our own food or anything like that, this is creating a situation where we may see grain, cattle, and any other of these like futures markets prices for agriculture start to really ramp up and exceed, especially going into the third quarter, fourth quarter of this year, and then going into 2027 and 2028. So, real quick, I'm gonna look at soy. Can look at soy. Chicago soybean futures. No, we're not gonna. The CME. No, it's only CBOT. Okay, so this is 1,002 cents. That's all cents that we have, right? Oh no, oh no, it's USD, USD. Okay, perfect, perfect. I was reading that incorrectly. Um, so war started February 28th. Let's see. Let's see a daily candle. What that daily candle doing? February. So I mean, since February 28th, we are up. We are up. Not too much because we did actually take out that liquidity from set February 28th. But man, you ask me, let me go back to the weekly. Um, ZS soybean futures. Yeah, man, you look at this like what's BUA of per bushel. Okay. Yeah, this is cents. So now let's do USD, US dollar. So obviously Ukraine war, Ukraine conflict, 2022. That's what we see here, the massive rise, and then we fell down. I would have to do the research of why we started to fall in June as hard as we did, but with this Strait of Hormuz crisis, if it were to continue on, and let's just say for another 3 months, and the Strait of Hormuz hasn't opened yet, there's no way that soy is staying below the all-time high. Like this all-time high is getting blown out of the water. I would probably like see it go to 20. $20. So I don't know yet about the risk tolerance for me for trading soy as of yet. I just need to do the research of how much it would cost to do these trades and what my stop losses would be. But as far as it goes with investing in like shares or even investing in like very low risk or just you don't care about losing money into it, you want to do a low risk trade into soy, man, I just there's no way I would see this like going lower. Like this is the target. This is the target going into like September. No, not September. I want to say December of 2026 and into 2027. This is the target here. So yeah, for right now, I'm focused on gold. Gold for me makes sense as just a commodity that's going to continue to go up. But we're going to pay attention to these grain prices given the fertilizer crisis that's coming up. Um, yeah, so I hope this is helpful. I hope my explanation of the way that I'm analyzing things technically is helpful. If you have any questions or if you have any like just concerns, anything you want to say, please just reach out to me. Appreciate you for watching. And yeah, we'll be back here next week.